in today's video, I'm going to be teaching you a very simple price action strategy that anybody out there can be able to use and be able to profit in the market. Without further ado, I'm going to dive right into the video, but do not forget my Telegram link is in the description. I share a lot of free stuff there, from tips to free setups and a few things to get you motivated and get you moving every single week. Right with me, I have a gold USD chart over here. And yeah, it's in a buy right now. It's a buy that I did share with my VIP in the morning. And as you can see, it's other broker. It's up probably about 150 pips. Quite an amazing trade. We did take the Euro USD as well, moving slow, and we're just right about to hit a take profit level over there. But that's not the purpose of today's video. And I'm going to get another chart right over here from which we can be able to learn today's strategy. Now, first and foremost, we are going to make use of two basic concepts, right? So the concepts are going to be, first, we have a level right over here and a level at the bottom, right? Now we all know that this level are basically called the resistance at the top and the support at the bottom, right? The resistance at the top, then support below it. Resistance, support, resistance, then support levels, right? Then you can break, when you break above resistance, it becomes your new support level. So these are very pretty basic beginner concepts that we use all the time. But when we have a resistance, it's like a price ceiling. And when you have a resistance, the price ceiling, price can go above that level, right? Whenever price comes to a resistance level, we expect it to reverse and go back down. And when it comes down to the support, you can term it as the price flow, price anticipated to bounce back and go back up over there, right? And instead, whenever price comes to a resistance, then it breaks above, this resistance now becomes our new price flow. And what do we expect? We expect that when price comes back over to this new support level, it's going to continue. Now, in the illustration I have below, on the chart over here, you can see price moves from this point to this level over here that I've drawn, and it bounces back. So this becomes our resistance. Then it comes back to this level and it reverses and pushes to the upside. So that becomes our support level. Then right over here, price actually breaks above this level, then it returns to the same level and continues upwards. So during this phase where price breaks above, we call this a breakout, and this resistance now becomes our support level, right? Then it returns back because now our resistance has become support. And what do we expect? We expect that support or the price flow pushes price back to the upside, right? Now, those are the levels we're going to look at mainly. But the whole ideology is, after you have these levels, what do I look for to either take that sell, or afterwards, what will I look for to take the buy, right? Because what we want to do at the end of the day. Now we're going to make use of those two levels, the support and the resistance. Then the other thing we're going to make use of are a candlestick pattern or a candlestick formation in particular, right? So let's take, for example, on the chart over here, I have two charts of two candlesticks. This could be my first candlestick. I have this, then I have another one right over here. So I'm gonna just make this and make it bullish. So this is my bullish candlestick and this is my bearish candlestick over here, right? So I'm gonna give them wicks for the bullish and then for the bearish, right? For the bearish, now I want to see this pattern or this kind of candlestick form at the resistance level over here, right? So now when it forms, I'm going to go ahead and mark this level at its wick, right? This is going to be my point of interest. It's going to be my point of interest. Now, what do I expect with this point of interest? What I expect that if price has done this and price happens to return back to this level, sorry, let me reduce just the font level on this. This level over here will be our point of interest, right? So instead of confusing you guys, let me show you the second kind of pattern formation when you're anticipating for sales. So this is the first kind of candlestick we're going to look for. Then the other candlestick formation you're going to look for is, let's say we are going bearish. Let's start with the bearish examples first to make it easier for understanding. We are going bearish. I have the first one. Then I have the second one right over here. Then of course they have wicks to the upside. So we're going to focus on the wicks to the upside because it's where the strategy comes out from, right? So what's going to give it purpose or meaning, and it's how we're going to drive our trades, right? So now, the second candlestick formation over here, it can be in a continuation or it can be in a reversal, just like this, right? Now for this in particular, it can be even in the middle of this over here. It can be in the middle of the price leg to the downside. This has to be at your resistance level. But then this works best as well, and I repeat, works best when it's at a resistance level. So we are going to focus on the resistance level. So the whole idea behind this, and if you're a beginner trader out there, you're going to focus on few but quality trades. You take a trade with multiple confirmations that has a higher probability of actually playing out, because at the end of the day, we are playing with probabilities and confluences. The more confluences, the higher the probability of the trade playing out. So as a beginner trader, to minimize the losses, because the losses do happen and they are a reality, you have to minimize the number of trades and you take more quality setups. You lose a trade when you know that it had a reason behind it or a narrative, as I always say. So now, for that case, we are going to consider this pattern forming after tapping into a resistance level. So in that case, it's going to be a reversal formation, right? Now, let's go down to how it plays out, right? So when I see the first case scenario right over here, what will I anticipate? I'm going to anticipate that price is going to move back up into this level, and particularly the wick over here. Now in this wick, price can either go into this wick or it can leave you a bigger wick or a rejection wick, right? But after leaving this wick, you want to see price form this kind of pattern right over here. So it could be a quasi-model or it could be a change of character or a head and shoulder, depending on what you call it. That's our confirmation entry over there. So that's what I'm going to be looking out for on the charts. So whenever price comes to this level over here, I'm going to go down on a lower time frame. I'll give you the time frames that you can consider in most cases. You go down to a lower time frame and you're looking for this pattern to form. Now when you see this pattern forming out, you want to take your trade on this level over here. Those of you who have traded the quasi-model or the change of character or the head and shoulder is quite different, but the change of character, how some people call it, or the quasi-model in particular. So we shall call it the QM for this purpose right over here. So this is where you want to take your trade. Now sometimes it can happen inside the wick, but sometimes it can actually just tap slightly into the wick level and reject it. But after rejecting, it goes ahead and gives you this pattern. Now usually this is the best when we have had a rejection of this level over here. Now this is for the case 1 scenario, and you'll go ahead and take your sell right at this shoulder over here, and your stop loss can either be here in case this is too big, but this would be best to put a few pips above it. Then you can go ahead and target your nearest structural low right over there. Now that's as simple as the strategy is. There is no much science, it's just the candlesticks, the resistance level, then you're going to wait for the reaction. When price reaches that level over there, your work is to wait. Patience. You wait for the pattern to form, that QRC model. The QM is a very, very high win rate confirmation. I repeat, it's a confirmation pattern. That's as far as I'm concerned, or how I use it when I'm trading. And this strategy in particular, when you're using it, that's the highest win rate you'll always have. Now for the case 2, I'm going to look for something very similar to that. Just that for the case 2, I'm going to have 2 possible scenarios. Now remember, I told you we are dealing with probabilities. So yes, there should be room for some failures in worst case scenarios, right? Now for the case 2, I'm going to have the first wick over here. Now this is called a double marabuzo pattern. Then I'll also mark out the first wick right over here. Now for case 2, I'm going to particularly want to have a reaction. By a reaction, what do I mean? That whichever candlestick is going to tap into this area is going to leave me a wick. It's going to leave me a wick that tapped into that area over there. Now this is for the case 2 in particular, because you want to look for extra confirmation. Now by this wick, what does the wick mean? This wick means that there is higher selling pressure from that zone, so it has a high probability of it holding. Now the reason you wait for that kind of rejection is because we have another zone above that, right? We have another zone above that that can be a magnet to price or a drawn liquidity, so price can still go to that zone over there. Now what I'm looking for is I'm filtering out. I could still want to take the trade inside the zone, but then to have lesser probability of actually playing out. So I'm screening out to take the high quality trade. So I'll focus on this wick over here. Now, after this wick has formed on my lower time frame, I want to just have the same kind of pattern. When price comes back, I want it to tap in, come break this low, then to this shoulder over here. This is where we take our sell trade. Then of course, in this case scenario, if it comes to the first level over here, my stop loss will be just above this high over here, because when it breaks above, it's going to go to the zone up over there. Now that's the case 2. That's the case 2 first entry you're going to consider. Now the second entry for the case 2 is going to be just like in the first case. We wait for price to go to the uppermost zone over here. Now in the uppermost zone, it can be in or it can wick out. As long as you get that quasi model in there, it will hold in the highest in most of the cases. Then you will take yourself right over there. Now that's the strategy. Now in the bearish scenarios, I'm going to just flip this and try to explain it. I'm going to invert this. Now in the bullish